Hi, I want to make a quick explainer for essential question number 4, version 2 in spring of 2011. This is kind of an extension of the Rod example. So this is the guy that actually collects bills from you. And so Rod's a collector, and you're going to pay him $12,000 a year. What it does is it makes it so that people actually will pay their bills on time. That means that the accounts receivable is going to fall. So it used to be something like $1 million, and now it's going to go on. It's going to be $850,000, something along those lines. And it's going to be that way for 3 years that you employ him, and then they're just going to pop up to the old levels that were before. I went ahead and set additional data that the combined tax rate is 40% and the minimum acceptable rate of return is 20%. So let's go over to the spreadsheet on how this is supposed to work. And the key things to remember here is that we're not paying any interest on anything. We didn't buy any assets, so nothing's being depreciated. So these little guys are going to be all sorts of zeros. In the income statement, the only thing that changes every year is that we're going to have these additional expenses of paying Rod. So we're paying him $12,000 a year. So I'll expand this out, so that you know that you're looking at that operating expenses there. So there's Rod's salary. So remember, the convention here is that if you have a positive number in expenses, that means your expenses are going up from what they were before. In each year, what you can do is say the taxable income is just operating revenue less all these other expenses below it. And so what you're seeing is each year your taxable income goes down by $12,000 a year. And that's going to mean that your tax is going to go down. So in each case, what I've done here is taken that decrease in taxable income, multiplied it by the tax rate, which is 40%, and said, here's how much your taxes are going down. So remember, what this means is that there's a reduction in the firm's overall taxes because of this thing that you're doing here with Rob, not they're actually negative taxes. The net income is just taxable income less tax, and it's the same in absolutely every single year. That's what keeps this being like a kind of an easy problem, because the income statement looks the same in every single year, so you got one fairly easy set of calculations. The easy calculations carry down into the cash flow statement. So cash from operations, you just take the net income from above, stack it back in, and you're done. And the only really tricky part that we're dealing with right here is making sure you understand how to use working capital. The idea is, because you hired Rod and he's collecting, that the amount of cash that you have tied up in working capital is $150,000 less than what it was when he wasn't there. So originally what you're going to see is this release of cash from working capital, not tied up in accounts receivable. So that's what this positive $150,000 is. And then when Rod leaves to go do other things like be an engineer, suddenly everyone stops paying their bills again. And what happens is that you have to go ahead and sink more of your cash into those accounts receivable. That's why there's this negative $150,000 here. The easy math then is just to go ahead and say, well, look, add all these things in the cash flow statement up, because positives mean cash inflows, negative means cash outflows. And so in the first year you hire Rod, you have a net cash inflow of $142,800. In the second year, the only thing that's happening is Rod's salary, and so you have a net cash outflow of $7,200. And then in the year that he gets fired, goes on to be an engineer, you have a net cash outflow of $157,200. Some of that is you having to have more cash tied up in accounts receivable. Some is the last set of wages that you're paying to Rod. Now, in order to figure out if hiring Rod's a good idea, you take the present worth of the sequence. And that's what I've done here. It ends up being a positive number, so hiring Rod's a very good idea. And that should be the explainer for essential question number 4, version 2 in spring of 2011.